Now, in the last class, I told you about the various schedules of Form B, that is profit and loss account. Schedule number 13, schedule number 14, schedule number 15, schedule number 16, and after that, you have to go for provisions and contingencies. Okay, after preparation of these schedules, you have to go for the profit and loss, okay, account. So when you are preparing, first of all, you have to write section 29, third schedule, Form B, profit and loss account of so-and-so bank for the year ended 31st March of the year. Now, we are going for the format. First one is income. Income. Under this head, you will come across two schedules. That is schedule number 13, that is interest earned, and other income, schedule number 14. So you have to total that. Then you have to write expenditure. Expenditure, that is the second heading. In that, you have to write interest expended, schedule number 15. Next, operating expenses, schedule number 16. Next, provisions and contingencies. Okay, you have to write and you have to total this. And you have to compare the income total as well as expenditure total. When income total is more than expenditure total, automatically you are going to get the profit. And vice versa. If expenditure is more than income, automatically you are going to get loss. And this profit or loss, whatever you come across, you have to show in the third heading, that is profit or loss. In that, okay, whatever it may be, the last year profit that we have or the banks that they have, as well as the current year profit. You have to take these two things and you have to total that. Then after third heading, you will come across fourth heading. Fourth heading is nothing but appropriations. Appropriations. That is what we have to do with this profit amount. Okay, current year profit. When you go for appropriations, mind it, first of all, you have to take into account statutory reserve. Every bank, every commercial bank will have a statutory reserve with it. And whatever it may be the profit that you got for the current year, okay, you have to transfer 25% of the profit amount to statutory reserve under section 17. So you have to write transfer to statutory reserve, okay, under section 17, 25% of current year profit. Don't take into account the last year's profit. 25% of current year profit only you have to take and you have to transfer. Then after that, whatever it may be the transfers that you want to make, that is transfer to general reserve, transfer to capital reserve, transfer to government proposed dividends, government or proposed dividends, all these things you have to write, whatever it may be the appropriations. And the last one only you have to transfer to balance sheet. Whatever it may be the leftover balance, that amount only you have to transfer to balance sheet. This is the thing that you will come across. Okay. From third head, that is from the third head's total, you have to take into account all the appropriations and you have to deduct. And whatever it may be the leftover balance, that balance only you have to transfer to balance sheet. This is how you have to prepare the profit and loss account of a bank. Now, coming to the Form A, I told you that you will come across 12 schedules, 1 to 12 schedules. Out of 1 to 12 schedules, 1 to 5 will show you the liabilities and 6 to 11 will show you the assets. And what are the things that we come across in first schedule, second schedule, all those things I'm going to explain now. In first schedule, you have to take into account the 5 types of capitals. So what are these 5 types of capitals, sir? Again, you are keeping a dilemma. The 5 types of capitals are nothing but authorized capital, that is the total capital of the bank, authorized capital, issued capital, subscribed capital, called up capital, and paid up capital. These are the 5 types of capital that you will come across. And okay, suppose if they are there, you have to show. If they are not there, okay, only paid up capital only, whatever it may be that you come across for a bank, you have to show that. Okay, first capital. Schedule 1, capital. Schedule 2, reserves and surpluses. Okay, reserves and surpluses. In this, statutory reserve. Okay, I told you already in the beginning, I mean just now, that every commercial bank will have some amount of statutory reserve. They have to maintain statutory reserve. So that reserve you have to take, and to that statutory reserve, whatever it may be, the portion that you transferred from profit and loss account, you have to add that and you have to show that. Okay. Statutory reserves, capital reserves, okay, share premium or securities premium, revenue and other reserves, all these things you have to show. And after that, whatever it may be, the profit amount, balance, leftover balance amount is there, no? So that profit amount also you have to transfer to reserves and surpluses. This is according to schedule number 2. Okay, reserves and surpluses. Now coming to third schedule. Third schedule, deposits. Okay, deposits. In deposits, you will have fixed deposits, demand deposits. Demand deposits are nothing but the current accounts. Okay, recurring deposits and savings bank deposits. Whatever it may be, the bank it is having. Okay, all the deposits you have to show them in third schedule. Okay, deposits. And sir, you are telling like this, but when you go for practical life, we'll come across different deposits, whatever it may be, the deposit. Okay, just for knowing purpose, I'm telling you. But when you go for a practical life, when you go take into practicality, you will come across different deposits, and whatever it may be, the deposits, you have to bring them and you have to show them in schedule number 3, deposits. Okay, now coming to fourth one, borrowings. Okay, borrowings. Whatever it may be, the bank that borrows within India and outside India. That is borrowings in India, borrowings outside India. So when you go for borrowings in India, you will come across RBI, other banks, and other financial institutions. Okay, all these things you will come across within in India. And outside India, whatever it may be, the places from where you brought, that thing you have to show. So fourth schedule is nothing but borrowings. Okay, and fifth one, that is other liabilities and provisions. Fifth schedule is other liabilities and provisions. So when you go for other liabilities, what are the items that we come across? Bills payable, inter-office adjustments, credit balance, mind it, inter-office adjustments, credit balance, CR, like that they will give. So that amount you have to take in this. Okay, inter-office adjustments, interest accrued. Okay, next, others. What are the others, sir? Okay, net provision for income tax and other taxes, surplus in provision for doubtful debts, contingency funds, transfer to government, proposed dividends, unclaimed dividends, unexpired discount, outstanding expenses, staff security deposits, etc. All these things, they must be shown under this fifth schedule only. Okay, so not only this, you'll come across, okay, drafts, TTs, telegraphic transfers, and travelers checks and bankers checks. All these things, they will come under the other liabilities and provisions. Okay, don't forget, all these things, they must be shown under the fifth schedule only. So with this, the liabilities part is over. The liabilities part is over. Now we are going for sixth schedule. Okay, what is sixth schedule? Cash and balances with RBI. Okay, cash and balances with RBI means, okay, cash in hand, cash in hand. The first one is cash in hand, including foreign currency notes. Okay, don't be of that opinion that they are excluded. Cash in hand, including foreign currency notes and balances with RBI. So what is this, sir? Every commercial bank, it is a customary duty and it is nothing but a mandatory duty for the banks to keep some amounts with RBI. So whatever they are keeping with RBI, that amounts also we have to take into account in this sixth schedule. That is cash and balances with RBI. Now, after sixth schedule, you will come across seventh schedule. What is that? Seventh schedule. Balances with other banks, money at call and short notice. Okay, this is the thing that you will come across in seventh schedule. Balances with other banks. And in this also, in India, outside India. In India, outside India. Both the things will come in this. Okay, in India, balances with banks, money at call and short notice. This is very, very important. Money at call and short notice, whatever is that. So suppose some the bank people, when they give money to a businessman, and the businessman will say, sir, whenever you give a call, I'm going to return the amount. Or whenever you give a small notice or short notice, I'm going to return the amount. So like that, the banks, they will give money to the business people. That too, don't be of that opinion to all the business people, whomever they are having, okay, continuous contacts, continuous transactions with the banks. For those people and the banks, those people who have belief, the banks, they must believe. So for those business people only, they'll go for money at call and short notice, not for all the business people. Mind it. Okay. Next, outside India, from whatever it may be, the balances that you are having in other countries outside India, that thing also, they will come under this seventh schedule. Next, after that, eighth one is investments. Investments. And this investments also, it is having two parts. Investments in India and outside India. Okay, wherever the bank, when they invest their money, the surplus money, whatever it may be, okay, when they do investments outside India in different organizations or in different companies or corporations, whatever it may be, you have to take that investments also as outside India investments. And sometimes within India only, they will invest. So those things also you have to take, and they will come under, okay, eighth schedule. That is investment. Okay, in India, investments in India I'm taking. Government securities, other approved securities, shares, debentures and bonds, okay, gold, all these things, they will come within India, within the country, whatever it may be, the bank that they go for investments, they will come under the head or the schedule, eighth schedule, that is investments. And outside India investments also, they will come under this schedule only. Now, after eighth schedule, you will have ninth schedule. Ninth schedule, advances. Ninth schedule is advances. So in this, you will come across three categories. Okay, three categories, A, B, C. Okay, three categories you have to take into account. First one is bills discounted and purchased. Bills discounted and purchased. Next, cash credits, overdrafts and loans repayable on demand. Cash credits, overdrafts and loans repayable on demand. Okay. Next, term loans, short-term loans, middle-term loans, and long-term loans. All those loans, they will come under this A category. Now, B category, secured by tangible assets, covered by bank or government guarantees, and unsecured. All these things, they will come under this B category. Secured by tangible assets, that is secured loans, covered by bank or government guarantees, and unsecured loans. All these things, they will come under B category. Now, coming to C category, advances in India. Okay, in advances in India, whatever it may be, priority sector, public sector, banks, others. Okay, all these things, they will come under advances within in India. And again, here also outside India, whatever it may be, the advances that you have given to other people outside India, that advances also we have to write in this schedule number 9. That is in under C category. After this, okay, you will come across fixed assets. Whatever it may be, the bank is having the fixed assets, we have to take under this. Okay, premises and other fixed assets. Okay, these two things, they will come under fixed assets. And after this, you will come across other assets. We can call this thing as non-banking assets. This other assets, the other name for other assets is non-banking assets. They are not related to bank. They are not related to banking. Okay, non-banking assets. So what are they? Inter-office adjustments, debit balance. That is inter-office adjustment, debit balance. Here you have to show in non-banking assets or other assets. Okay, credit balance you have to show in schedule number 5, and debit balance you have to show in schedule number 11. Interest accrued, tax paid in advance or tax deducted at source, stationery and stamps, non-banking assets acquired in satisfaction of claims. All these things, they will come under other assets. That is nothing but schedule number 11. And after this, one more schedule we have to show, and that is nothing but contingent liabilities. Contingent liabilities. Mind it, this schedule you have to show, but you should not take into account. Just for showing purpose only, this schedule will come. And other mean, you should not, there is no necessity for you to count. Okay, up to from 6 to 11 only have to count, have to total. But this thing, it will appear just as a showcase. Okay, fine. And contingent liabilities. What are contingent liabilities? Claims against the bank not acknowledged as debts, liability for partly paid investments, liability on account of outstanding, forwarding, exchange transactions, guarantees given on behalf of constituents, acceptances, endorsements, and other obligations, other items for which the bank is contingently liable. These are the various contingent liabilities that you will come under schedule number 12. So 1 to 2 times or 3 times, I'm telling you, this will appear, this schedule will appear just as a show piece. There is no necessity for you to count that. Okay, so these are the various schedules that you will come across in the financial statement. That is nothing but balance sheet. Now, when you are preparing the balance sheet, okay, first section 29, third schedule, form A, balance sheet of so and so bank as on date. Okay, in this number 1, capital and liabilities. First one is capital and liabilities. Under capital and liabilities, what are the things that you come across? First one is capital, schedule number 1. Reserves and surpluses, schedule number 2. Deposits, schedule number 3, borrowings, schedule number 4, and other liabilities and provisions, schedule number 5. Only these things only have to total. Thereby you'll get liabilities total. Next, below that, assets. Okay. Cash and balances with RBI, schedule number 6. Balances with other banks and money at call and short notice, schedule number 7. Investments, schedule number 8. Advances, schedule number 9. Fixed assets, schedule number 10. Other assets, schedule number 11. Only these items only you have to total. So thereby you will come to know about the assets total. When liabilities total and assets total, when they are one and the same, okay, it means that the balance sheet is agreed or it is tallied. Now, after that, you have to write, okay, contingent liabilities, schedule number 12. You only have to write that. Okay, and after that, bills for collection. This thing also you have to show. Okay, like a showpiece, you have to show these two things. And with that, the balance sheet is set to be completed. And regarding the appropriations and other various adjustments regarding this bank final accounts, I'm going to take in the next class. Okay, until then, have a nice day.